Let's turn back to today's big rally. Stocks surging today as bond yields bounce off their lows. But this might not be an all clear for the bond market. If you watched the show last week, you'll remember our next guest said we are hardly out of the woods when it comes to the rate shock.
You could probably make the case that we're probably closer to a yield low around the rest of the world. But in the U.S., it looks like it's early innings for rates to fall because we're so far behind everybody else.
Let's welcome back in Jim Bianco, president of Bianco Research. Jim, great to see you again.
Thanks for having me.
So equities are basically telling us, they're back to practically where they were before. Nothing to worry about. Bonds also, Jim. So what gives?
Well, bonds bounced back, but they're lower than they were last Monday when they made a new all-time low. Prior to last Monday, the all-time low in bonds was 210. We're at 209 right now. They had a great rally over the last 10 days or so. They fell 60 basis points. You got to go back 7 years to find the last time they had a rally that big. And this is one of 5 or 6 rallies of the last 30 years of this size. So I'm not surprised that they're kind of bouncing around. I still think the path to least resistance for bond yields is lower unless Jay Powell comes out and opens the door for a 50 basis point cut at the September meeting. If he does that, possibly we could have a low in bonds. But short of that, if he comes out and he's not dovish enough, we could have another plunge in yields as far. That's what the market's trying to tell us right now.
What kind of plunge are you predicting? And is it the same sort of degree of sell-off in yields that you had predicted before? Or does the bounce back change your view of the bond market and where it's headed?
No, the bounce back doesn't change my view. Let's keep in mind now that interest rates is a relative game. The rest of the world matters. 60% of sovereign bonds or treasury bonds around the world are negative yield. Sorry, that matters. There's only 2 interest rates that have a 2% or higher yield left in the world. The Fed funds rate and the U.S. 30-year bond. And those rates are going to have to keep coming down with the rest of the world. I could see them going well down. The funds rate should probably go down to 1.5 by fall. I could see that the 10-year or 30-year could go down to 175 by fall, unless the Fed gets very aggressive and they cut 50 basis points. That's the game changer. Short of that, I think we're going to 175 on the 30-year bond.
Jim, thanks. Jim Bianco,
Bianco
Research. We had a little bit of a static issue, so we had to say goodbye to Jim a little bit early. Do you agree with Jim? 50 basis points is the only thing that's going to cause the bottom in yields.
It's interesting he says that. I would say the Fed has no control over yields at this point. You would like to think that the Federal Reserve somehow controls things. I don't think they do. I don't think any of these central banks do, although they think they do. In terms of what Jim said, 25% of all sovereign bonds have negative yields. That's not bullish in my world. Obviously, the market's looking past it now. The last 4 days in the equity market has been very good. But the problems that got us in market in turmoil last week didn't magically go away today.
I absolutely agree with that. When we look at it from an equity perspective, we don't think risk is off the table at this point in time. It would not surprise us at all to see the S&P 500 approach 2,700 before you can finally breathe a true sigh of relief.
I'm curious, Lori, because we have so many strategists who say lower yields are great because it provides you a cushion for valuations. Yeah. And at some point, we cross that line.
Yeah, I think we've already crossed that line. We do generally see that when rates are coming down, that PE multiples go up. But guess what? When we hit the 30-25-ish top in the S&P earlier this year, we did basically all of the multiple expansion we deserve to do in this cycle. You have to remember the market has been pricing in lower rates and cuts from the Fed ever since January. We kind of got into that easing rally mode. And unless you're in a QE environment, the multiple expansion we've already seen is as good as what we tend to see when the Fed is easing. So I think it's done.
I think we have a case, folks, where good news actually could be good news again. We're going to get Fed minutes on Wednesday. I don't think that those Fed minutes are going to be as dovish as people are going to want them to be. Eric Rosengren was out there today, a voting member of the Fed, that basically made it sound like he doesn't want to go. He doesn't like the ramifications.
It's been that way for a while.
Well, but it's interesting to hear the Fed say this, and at a time where you guys, I think, are right to say that the Fed is largely irrelevant, the fact that we went from bad news is good news to a point where I actually think that good news is good news, or that bad news, Lori is saying bad news is bad news. I hear that, and I think actually, based upon what you heard the administration, whether it was Larry Kudlow, all the weekend press, the retail sales last week, if the consumer is so strong, why are we in such a bad place? And I kind of feel the same way.
Yeah, the timing seems horrible for the politicians to be making this case for such a dovish stance right now. And you think about it, I mean, look what's going on. Look at the dollar. You see where the Dixie is. It's above 98. You see, obviously, bonds. I mean, it's been a
That's
flight
central bank differentials, by the way. The same thing that our guest was talking about.
Understood. And I just think if you look at our treasuries, you look at our dollar, and you look at our stock market, we're showing tremendous relative strength to everything else in the world. And I think what's really important about those two big 800 down days in the Dow over the last couple of weeks is that risk happens fast, and all of a sudden, when people didn't like it, whatever the excuse was, higher tariffs or a yield curve inversion, they sent them down 3.5% sharply. And if Q4 2018 taught us anything, the days like that, the more frequently they happen, they can snowball, and we can turn into a 20% peak to trough decline. And make no mistake about it, that was a crash, people. A lot of people made a lot of mistakes at the highs in September and October and at the lows in December, and that's how you get offside. So to me, I just think that whatever's going on here, none of us have answers. You're the only strategist here. The rest of us are a bunch of stock jockeys. We just don't know how this ends, but it can't be good when you have 25% of sovereign yields around the world negative, and you have our our White House pressuring for a 1% drop in the
check out what Dan's sneaking stuff in there. What do you think? Whether he's actually meant to say them or not?
He just slips it in there.
I'm not owning that.
Slide that in there.
I'm too big to be anything jockey, so.
That's very true.